Many of us are familiar with different investment options that can help us reduce our tax outgo. For instance, let's talk about the widely known Section 80C. So there are several schemes including the Public Provident Fund (PPF), National Pension System (NPS), and Equity Linked Savings Schemes (ELSS), which allow us to enjoy tax benefits. However, you must know that there are alternative avenues for tax saving that do not require any investments. So there are certain expenditures that can also help you avail deductions and save thousands of rupees in taxes. Hello and welcome to our channel 5-Minute Finance by ET Money, where we talk about the basics of personal finance. In this video, we are going to talk about 10 ways to save tax with no investment. So let's get started. This deduction is available to salaried employees who stay in a rented house and receive house rent allowance component as part of their salary. Now, the amount of HRA deduction depends on a few factors such as your salary, your HRA receivable, your rent, and your city of residence. Look at your screens. You can claim the lowest of these three amounts as your HRA deduction. First, 50% of your basic salary if you live in a metro city, or 40% in case of non-metros. Second, the actual amount of HRA that you received from your employer. Third, the excess of rent paid over 10% of your basic salary. Now, coming to the best part about the HRA deduction. You can claim it even if you pay rent to your parents. But you need to have a valid rental agreement with them and they should show the rental income in their tax returns. Next, we have leave travel allowance. If you are planning a trip, don't forget about this tax benefit. Salaried employees traveling within India for family vacations can claim this benefit under Section 10(5) twice in a block of 4 years. The current block is from 2022 to 2025. Now, there are certain conditions to claim LTA. The amount of LTA exemption depends on the mode of travel. Also, the journey should be undertaken through the shortest possible route through air, rail, or bus. And remember, only the cost of tickets booked for travel would be allowed as an exemption. Costs incurred on conveyance, sightseeing, accommodation, shopping, food would not be allowed. If you have taken a home loan, here's some good news for you. Section 24 of the Income Tax Act allows you to claim a deduction for the interest you pay on your home loan. The deduction allows you to claim interest paid up to 2 lakh rupees every financial year. And in case you have rented out the property, entire interest amount can be claimed as deduction without any upper limit. Now, beyond interest, the principal repayment component of your home loan can also be claimed as deduction under the most popular Section 80C of the Income Tax Act. You can claim a deduction of the principal amount repaid up to 1.5 lakh per year. This includes stamp duty and registration charges paid for the property transfer as well. So if you are looking to invest in PPF, EPF, NSE, ELSS and so on to claim tax benefits under Section 80C, subtract your home loan principal repayment amount to figure out how much you need to invest. And by the way, before we proceed, let me remind you that most of us have received email from our HR department to submit the actual investment proofs. And if you are looking for a one-stop shop for all your tax saving needs, you can go to the ET Money app, which allows you to invest in ELSS funds, NPS, buy life insurance, health insurance, and much more. And the best thing, once you invest, you can obtain instant tax saving proofs as well. Coming back, let's talk about two more types of expenditures which can be claimed under Section 80C. Let's look at them one by one. Protecting your loved ones can also be a tax-saving strategy. Under Section 80C of the Income Tax Act, you can claim a deduction of the premiums paid on the life insurance policy up to 1.5 lakh per year. But this is available only for policies whose premium is not more than 10% of the sum assured. Another expense that can be claimed under Section 80C is the tuition fee of your children paid to an educational institute. You can claim the tuition fee paid for up to 2 children up to 1.5 lakh rupees per year. But remember, only the tuition fee component is allowed. This does not cover other costs like books, transport, hostel, or any other fees. Another expense that can help you to save taxes is the premium paid towards your health insurance policies under Section 80D of the Income Tax Act. So you can claim up to 25,000 for the premiums you pay towards health insurance policy for yourself, your spouse and children. Additionally, you can claim a deduction of up to 25,000 rupees premium you pay towards health insurance policy for your parents. And if they are senior citizens, this amount goes up to 50,000 rupees. That means you can claim a total deduction of up to 75,000 from your taxable income. Now, just to give you a rough estimate, assuming you fall in the 30% tax bracket and you pay a total 75,000 rupees as health insurance premiums in a financial year, you will be able to save taxes of up to 23,400 rupees. Now, Section 80D also includes deduction on expenses incurred for preventive health checkups up to 5,000 rupees in a financial year. Section 80E lets you deduct education loan interest for the higher education of yourself, your spouse, or your children. You can claim the deduction without any limit, but only for 8 years or until the interest is paid in full. Next, giving back to the society can also help you save on taxes. You can claim a deduction for any donations made to eligible charitable organizations during the year under Section 80G of the Income Tax Act. However, any donation exceeding 2,000 rupees in cash will not be eligible for deduction. Also, the deduction rate can be 100% or 50% of the total charity depending on the institute. And the last but not the least is to claim the standard deduction of 50,000 rupees. This flat deduction is available to all salaried employees regardless of income level or expenses. You don't need to submit any bills or proofs to claim. It is automatically deducted from your gross salary by your employer. So for instance, if your gross salary is 10 lakh rupees, you can reduce it by 50,000 and pay tax on 9.5 lakh only. Now, while all the above deductions are available under the old tax regime, the standard deduction is available both under the old as well as the new tax regime. This brings us to the end of the video. If you have any questions, ask us in the comments below. And if you like this video, please hit the like button and subscribe to our channel. Also, do not forget to share this video with your friends and colleagues to help us educate even more people.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.